Hi and welcome to Hedge Fund Manager. I'm Karl-Mikael Siding. In this deep dive of FX, or comfort systems as they are called, we are now at the fundamental stage. And I like to bring up this screen in Koyfin. I like using Koyfin for the fundamental part, but there are many other really good programs, and usually also better programs for local companies from Sweden or Germany or France or the US. But Koyfin is a really good overall program for most international stocks. And this screen here is the screen you get if you just start Koyfin, enter FX as the company that you're looking for, and then here on the left you choose financial analysis and just click highlights. Then you get this screen if you zoom out a little bit, and in here you can see all the important fundamentals at the same time, more or less all of them. So you have revenues and profits and market cap and the debt situation, all of it at the same time. Just by looking at this screen and seeing all these double-digit green numbers everywhere, tells you right away that this is a profitable company and that is growing quickly and consistently. There are good numbers everywhere. So let's take a little bit closer look at how good they are. Well, just hovering above revenues, now I have the quarterly view. You could just as well take the yearly view, but using the quarterly view means that you would right away see if there are any specific quarters that stand out as particularly negative or positive, and that is an indication of some one-off events that we want to keep track of. The fewer one-off events, the lower the risk is, the lower the risk of making a forecast that disappoints, and where the outcome disappoints. And here in the sales numbers for FX, it looks pretty stable and very positive. There's something happening right here, starting in mid-2021, where it kind of takes off and it starts growing more quickly. And that could be worth checking out, like what is happening here. Is it due to external factors? Do they have new management? Have they started acquiring companies? Things like that might be worth checking out after an acceleration like this. We can also see kind of a deceleration here at the end, a plateauing, a leveling out, which might indicate that they will not grow as quickly going forward. And we can hover over the growth rates here and see that sales growth has been, at least it was affected by the troubles in 2016-17 and of course during COVID. But I think that it's worth pointing out that even though they got into the negatives during COVID, where the entire world was just stopped, they only reduced their revenues on an annual basis in their absolute worst quarter by just about 3.5%. So that this is an indication of a really stable operation where they have complete control over what they are doing. We can also see it in their gross profit margins, that although their typical level is somewhere around here at about 20%, at the absolute worst point during COVID, they only got as low as about 17% from their typical level of about 20%. Again, highly indicative of quality. Let's check the net income margin. As you can see, they have been going through a period of improvement, coming from levels here around maybe 2% at the worst, between 2 and 4%. And then there is a ramping up here over the last 3 years, although they had an outlier quarter here in 2022. But in general, there's been a positive net income margin trend, but still we're only at, as you can see, 9.24% here. If it's difficult to see in the diagram, just look at the table instead for the actual numbers, and you can see here that in the first quarter they were at 9.24%. Over the last 12 months they are at 8.13%, and you can also discern the positive trend here. One thing to point out is that a net income margin in a high quality company, it can definitely be a lot higher than 9%. I mean, remember all the software companies that are in the 30, 40, 50, 60% area or in terms of net income margins. And also having a gross profit margin, which Comfort Systems has here at about 22%. As they scale up and become the gross profit margin, more of it will fall down through the P&L down to the net income level. So there is definitely room for improvement, but there is also a slight risk that they, at least temporarily, go back to the levels they have had more recently. It's hard to tell, of course, from just looking at the numbers, because we don't have the exact reasons why they have been improving. But at least I think it's very logical that a company like this, of this size, that it should be able to keep improving their net income margins. And so as I said, we have a strong growth rate, good net income growth. Let's check the EPS growth. So hover here over the year-on-year growth for EPS. This is a bit harder to actually see what they are doing because they have EPS growth rates of up to 100%. So between in just this the last 8 quarters or so, between 40% and 94%. So what is their typical level? How quickly can they sustainably grow their EPS? And I would say that if you grow your sales by about 15% and you get a slight economies of scale effect over time, then a 15% revenue growth should easily translate into a 20% EPS growth in just rough terms. But here the average looks more like a 35% EPS growth, but that would be just highly unlikely that you could keep growing at that speed. Cash flows looks really good, except for the last quarter. So what can that be about? Well, you can simply check the cash flow numbers here, and in the cash flow table you have the days sales outstanding and days payables outstanding. There's the change in accounts payable, and hovering over that you can see how there was a very big change, some kind of a correction, some kind of a one-off event happening here in the last quarter, worth paying attention to. You can also just simply check the days payable outstanding, which you get under the key ratios directly from Koyfin, and you can see how they have been increasing their days payable, which is really good for cash flow. And then they had a temporary setback, and they keep getting these temporary setbacks, but with a positive trend with increasing payables. So apparently their clients don't mind, or their suppliers don't mind getting paid late, because this is a really good client. So FxV is a good client of their suppliers. Another angle might be checking the return on assets, which is improving and also having a really good level of over 10%. Return on equity numbers is also a way to check profitability. And having a 25% return on equity, which they have even better numbers. That means a doubling of equity every 3 years. This is really, really good numbers. But let's check these in more detail in the second part of the FA fundamental walkthrough.